Hello, I am Silvina Aldeco-Martinez, and I have the pleasure of being accompanied by Matthew McKee and Maria Shevchenko, both speakers at a very recent webinar we organized with GT News on facing up to bank counterparty credit risk challenges. S&P Capital IQ regularly hosts webinars on topical industry issues. So let me now turn to the speakers, and perhaps start with you, Matt. You started the webinar talking about sovereign risk and banking system risk. Can you explain why?
So there are several components to sovereign risk. You have transfer and convertibility risk. This is the risk that a sovereign will interfere in a non-sovereign entity's access to foreign exchange. There's country risk, so that could be anything from political corruption to regulation. There's banking system risk. That's the macroeconomic and industry risk factors that affect individual banks' banking environment. And then we move on to foreign currency default risk and local currency default risks. Now, these last 2 points are what a sovereign credit rating is actually referring to. And we found that there are some analysts who are using sovereign credit ratings as a proxy for country risk. So we wanted to make clear that credit rating agencies don't use sovereign credit ratings, or they don't want them to be used in such a fashion.
Thank you. Maria, moving to bank counterparties analysis, you presented a 4-step framework, right? Can you share with the audience a little bit of details about the framework?
Sure, yes. So we suggested a 4-step framework to go about analyzing bank counterparty risk. The first one was to analyzing specific banking systems that you have exposure to and concentration, followed by looking more in depth into those specific banking systems at all of the banks that you have exposure and not exposure to. Moving on to trend analysis, again within specific banking systems, and all finalized by effective monitoring of counterparty as well as sovereign risks. And all of that is also very vital to point out that it should be all done in combination with timely and accurate fundamental data.
Definitely, thank you. Matt, in the webinar, you actually utilized the example of the Czech Republic and Ukraine as geographies where you looked at the banking system risk. We received a question as to whether those 2 examples are representative of the wider European region, Eastern European region. Can you provide some insights on this?
Yes. So the Czech Republic was a particularly interesting case. We started with 3 rated banks, and using fundamental data, we were able to run that through our credit model platform and expand the number of banks that we had a credit view on. So there's a difference between a credit rating and a credit score. The credit model score is quantitatively derived. So we were able to get a further 27 banks, and we could see when that was charted that there was quite a broad range of credit strengths within the Czech Republic, starting from BBB+ and going all the way down to CCC+. There was only really one other country where we saw a similar breadth of dispersion, and that was Russia, where it ran from BBB+ to CCC-. There were a couple of countries which were slightly in the middle, Hungary and Poland, and for the best part, the remaining countries, we looked at the Ukraine in the webinar, but as well as Romania, Estonia and Lithuania. Those countries, due to having a weaker banking system, those scores were pushed to the weaker end of the credit spectrum.
Thank you. Maria, moving on to monitoring. In your 4-step framework, you mentioned setting up an effective risk monitoring being one of the key aspects. How can this be best achieved?
So we suggested a framework of looking at complementing the long-term proxies for risk. So typically those are long-term credit ratings that the treasurers are using with short-term market indicators. We used 2 in our examples, which was market-derived signal looking at CDS signals, and also market signal for probability of default to complement the long-term indicator to see and view whether those are deviating from the long to medium-term views.
Thank you, Maria, and thank you, Matt. And thanks for the audience to tuning in with this summary of our webinar. The full webinar is available for you to download in S&P Capital IQ website, which is www.spcapitaliq.com. And looking forward to discussing some of our upcoming webinars with you. Thank you.